Microsoft is scheduled to report quarterly financial results when the stock market closes on April 30th, 2025. So investors are curious if they should buy Microsoft stock before it announces those earnings, because typically earnings releases are high volatility events, and sometimes stock prices jump by 20 or 30% following an earnings release. But also sometimes stock prices drop by 20 or 30% following an earnings release. So that's why investors are very curious about timing that purchase either before or after. I'll discuss those dynamics in this video. I'll also share with you my proprietary discounted cash flow valuation, which calculates a fair price or a fair value for Microsoft stock and what I think they're worth today. I'll preview what you should look out for from from Microsoft when the company reports its earnings as well. There's a couple of big things, including AI spending and tariffs, that investors should know about.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the last time Microsoft reported their earnings results, they delivered revenue of $69.6 billion, which was 12% above what they reported in the same quarter the prior year. They also reported operating income of $31.7 billion, which was 17% above what they reported in the same quarter last year. So Microsoft's revenue is increasing by double digits. Its operating income is increasing by more than that. So things were going pretty well for Microsoft up until, of course, these latest tariff announcements, which have the potential to disrupt all of that. Now, Microsoft is not at the very epicenter of these tariffs. Unlike Apple, which is at the very epicenter, Microsoft's revenue are primarily derived from software rather than physical products. But that doesn't mean Microsoft is not impacted, right? Microsoft generates much of its software sales into people that are buying personal computers and selling Windows licenses and other computing services related to Microsoft Windows, things like Microsoft 365 subscriptions, and other things related to PC sales. So Microsoft's business is still dependent on physical hardware sales, but not so much so like Apple is, where most of its revenue, more than 80% of its revenue, is coming from physical product sales, right? So the other thing investors will want to know from Microsoft's quarterly earnings release is the commercial remaining bookings valuation and bookings growth. So in the most recent quarter, its commercial RPO, remaining performance obligations, totaled $298 billion, and that was up from $259 billion in the prior quarter. That's big growth, right? Roughly $40 billion increase in remaining performance obligations from its commercial segment. This is services like cloud computing and services related to artificial intelligence, the computing power it sells to one of its partners, OpenAI, for ChatGPT, etc. So you're going to want to see continued growth in this segment, because this is the primary reason why Microsoft is spending so much money on its data centers optimized for AI, so that it can offer these services to enterprises that want to utilize them. That's the next thing I want to share with investors. You want to know about what they're doing with their AI spending. They forecast that for 2025, they're going to spend roughly $80 billion on capital expenditures, with most of that being for data centers optimized for AI. Are they keeping those plans, or are they changing those plans now that the tariffs that were announced by President Donald Trump are disrupting economies worldwide? Has that changed Microsoft's plans? And earlier in the video, I misspoke and I said Alphabet, because I've evaluated Alphabet's business as well, looking at its business. And what I said for Alphabet, I'm going to say for Microsoft, because they're in the same boat here for AI. And that is, I want to hear Microsoft actually doubling down on their AI investments rather than pulling back from their AI investments. Microsoft is a business that's known for generating great returns on investor capital. And so, if they're spending this money on AI, it's very likely that they expect great returns from these investments. So, if they're pulling back from those spendings, that means they're not expecting as great a return on those investments. So, that's actually bad news. You don't want to see them do that. You want to see them come out and say, our demand for AI remains robust. We still see this as a great opportunity. Our customers want this product from us. We remain supply constrained. And so we're still going to invest to expand our capacity. That would be great to hear from Microsoft if I was a Microsoft shareholder. So I would be looking out for comments related to their AI spending and AI demand and how that demand has changed as a result of tariffs. So now let's look at valuation. According to my proprietary discounted cash flow valuation for Microsoft, I calculated a fair value for its business at $414.14. That compares well to the current market price of $367. There's enough of a margin of safety there where I can say that the stock is undervalued according to my calculations. And even if it was fairly valued, I would think it would be a great opportunity because Microsoft is an excellent business. It's up there in the Hall of Fame of businesses in terms of how effective it is, the competitive advantages it retains, all of the factors that I look out for. And in my 6-step investing framework, right? I wrote a book elaborating on the 6 steps that I look for when I evaluate a business, and Microsoft scores very well across all of my 6 steps. And so it's an excellent business in the Hall of Fame. So I would be willing to pay a fair price, but I can get Microsoft stock at an undervalued price at $367. What's more, when I measure Microsoft's valuation on a forward price to earnings basis, it's trading at a forward PE of 26.7, which I'm looking at here on finchat.io. And this is near the lower end of where Microsoft's forward PE valuation has been, going all the way back to 2021. Briefly, in 2022, you were able to buy this business at a lower valuation. But remember, in 2022, we had that other scare, which investors were afraid of a recession as a result of increasing interest rates. Now, investors are equally afraid, maybe even more so, of an oncoming recession because of tariffs and how rising tariffs will impact worldwide economies. So, to answer the question, do I think Microsoft stock is a buy? And do I think you should buy it before or after earnings? So I think those are two separate questions. So whether or not I think Microsoft stock is a buy, the answer is yes. I do think the stock is a buy, as I talked about the reasons why. But whether or not I think you should buy it before or after earnings is a separate question. So if you've already made the decision to buy Microsoft stock and now the only decision is whether to buy it before or after earnings, I would say that this is a situation where I would go half and half, buy half before earnings and half after earnings. As I said, I do believe Microsoft's shares are undervalued, but I also said that the company faces higher than usual risks because of investor concerns of an oncoming recession. Earnings releases, as I mentioned also in the video, tend to have very volatile price reactions. Stock prices can go up or down by 20, 30, 40% following an earnings release. Although Microsoft is a bigger company, it doesn't fluctuate by those large numbers very often. So I wouldn't expect that kind of move for Microsoft. But if you're one of those investors that is concerned about that risk, I would say split your purchase half and half, half before earnings, half after earnings, to reduce the risks on both sides. You reduce your downside risk and you reduce your upside risk by doing it half and half. Hey everyone, I'm excited to announce a brand new private Discord for our channel members at the VIP Discord level. It's a great place to connect with me directly, engage with like-minded investors, and learn more and take your investing to the next level. Spots are limited, so join now before it's too late.